Recipes for technical trading success in Cook's Kitchen.
Hey everybody, welcome back to the kitchen. We've got insanity going on Wall Street right now. Here's GameStop up probably $200 at one point, 150%. Insane short covering. And today we want to talk about the options dynamics of this. I have a little bit of options experience. I was a clerk on the floor of the Chicago Mercantile Exchange in the 90s. Took classes from Shelley Nattenberg, who wrote the Bible of options volatility and pricing. And then I got to work for a big options firm in Chicago, Peak 6, where I just learned a ton more. And, you know, one of the dynamics here that you just need to understand if you're not an options trader is that, hey, when people are buying call options, the market makers have to turn around and buy the stock. And that sort of feeds on itself and drives things higher. And we saw a big example of this. Let's take a quick look. Last September in NASDAQ stocks and the S&P. Remember when the market initially made this peak up here, S&P 3600 or whatever, and then fell hard. Well, this euphoria run up was partly driven by, I think SoftBank was buying a bunch of calls and driving everything higher in big cap tech. And at the time, we got some great insight on this from my colleague, Dave Boren, who was a professional market maker. I was never a market maker. Dave definitely has the credentials here. From 1997 to 2012, he was a professional options market maker on every exchange, CME, CBOT, CBOE, and he actually managed a 25-person prop group from 2006 to 2011. So he knows his stuff, and he just wrote a great article on this yesterday where he talked about the options dynamics. Let me see if I just scroll down here on the quote page for GameStop, I find the article right here, How Options Trading is Fueling the GameStop Rally. As that page loads, I want to bring in Dave Boren. Dave, thanks for joining me today in the kitchen.
Nice to be here. Thanks for having me, Kevin.
Yeah, so, in your article here, you go over some of the basic mechanics of how options trading is fueling the GameStop short squeeze. Explain to us, obviously, most people understand short interest, but there's a couple of things feeding off of each other here where the float may be too small for the shorts to cover, and then how is the call buying also driving the stock higher?
Sure. So I think most people sort of intuitively understand the concept of short squeeze. There's an asset. It could be a stock. It could be a physical asset. Precious metals have commonly been the targets of people attempting to pull off a short squeeze, where someone just simply attempts to buy more than the available supply of that asset, meaning that anyone that's short it is forced to cover at whatever price the buyers decided is the price they're willing to sell. And generally, that's a lot higher than the market price when the squeeze starts. Pretty simple concept. The options version of that, and you're going to hear this referred to certainly in the coming days as a gamma squeeze, is that when people buy options from an options market maker, that market maker is going to hedge the position, which is now a short option position, by buying the underlying himself or selling the underlying in some cases, which I'll get to in a second. So to start, fundamentally, options market makers typically don't want to have a position in the direction of the move in the underlying. All right, they want to, first and foremost, they want to get the bid-ask spread. And they'd love to get the bid-ask spread as many times as possible while having as small a position as possible, because that's very low risk profitability. They also might want to trade the levels of implied volatility. As the price of options moves up and down, they want to sell more expensive options and buy less expensive options. But in all but the rarest circumstances, they don't really want to have a bet on the direction of the stock, because just like you, me, and everyone else, no one really knows where a stock's going later today, tomorrow, and out into the future. All right, so that's significantly less consistently profitable and riskier trading for an options market maker. So if you go to an options market, if you go to the options market and you buy an option, there's a good chance that you're interacting with a market maker. Some chance that you interact with someone else that simply wants to sell that given option at your price at this moment. But given that there are, a few thousand stocks with options listed and millions of option series, individual options, with thousands on a lot of those stocks that are listed on the exchanges. To provide all the liquidity at all of those symbols simultaneously, it really takes the technological ability of a market maker. So there's a good chance that if you buy an option, you're buying it from a market maker. If you buy a 25 delta call from a market maker, that's an out-of-the-money call at which, at the current level, the price of the call is going to move about 25% as much as the underlying will. The market maker is almost certainly going to buy somewhere around 25 shares of stock for each call that you buy from him, reducing his delta exposure, his exposure to movement in the underlying, to effectively zero. All right, so that's an important thing, is that when you buy an option, that option market maker is going to buy stock. I mean, when you buy a call option, the market maker is going to buy stock. Obviously, if you sell him a call option, he's going to sell stock, and it works in reverse for puts. But basically, the market maker is going to hedge his delta. Now, that delta doesn't stay the same throughout the life of that option, right? It's going to change as the option gets closer to expiration. It's also going to change as the underlying moves. So in my example in the article, if the option that you bought at 25 delta, the stock rallies, that option is now a 50 delta, which would be an at-the-money option, that market maker is now short another 25 shares of stock synthetically because of his option position, and he has to buy more. If that option goes to a 75 delta, 25 more, all the way up to 100 delta. And now this is a point that I didn't quite get to in the article yesterday. I was trying to just sort of scratch the surface of this gamma squeeze, but the gamma squeeze, it does have a sort of finite end to it in a way that a typical short squeeze does not. And that's that by the time the market maker has hedged that option at 1-to-1, it became a 100 delta option, and he is now long 100 shares of stock against his one short option, he's not going to buy anymore. So there's somewhat of a natural ceiling on these. GameStop has been ripping through the top strike that they have listed every day for the past 3 days. But that means they're getting into options that no one's ever traded before. So when we went from, at one point, I think 115s or 120s on Monday was the highest listed strike. It blasted right through that strike. And today we're trading.
So Dave, let me ask you, so when the market maker is forced, to things are at 100 delta, and is the market maker still, relatively hedged, and so that they have, controllable risk?
Sure. So if in this case, if the stock goes from 115 to, like we saw today, it's trading around 330 right now. So those 115 calls that were heavily traded on Monday are now 100 delta, and any market maker that sold them is likely long 100 shares of stock against it. As long as we stay up here, he's indifferent about the direction of stock prices, because we could go up or down $50 in the stock. We could go up an infinite amount and down probably about $50 in the stock before that option is no longer 100 delta. So for every dollar he makes on the option, he loses on the stock, and vice versa. So for up here, he's hedged. He does still have risk if we were going to go down back toward that strike, because he's still short the option, and now he's long all those shares of stock. So that position actually replicates the same thing as him being short the put on that same strike.
And can things
he still
get driven?
Does have some exposure to the downside, but once he's hedged all the way, he has no more exposure to the upside.
And can things get driven back the other way if all of our long call buyers who have these massive lotto riches, they start selling their calls? The market maker has to buy those calls and then sell common stock, right?
Absolutely. And you'd expect it to go in exactly the opposite direction at roughly the same pace. If they were to sell it in the same numbers and at the same pace that they bought, we'd see the same exact action in reverse, or something very similar.
I want to take a look at some of the other short squeezes going on, because it's happening. Around MarketWatch did a piece this morning. It's not just GameStop, and this morning you saw AMC, the movie theater, Express, which I believe is the clothing store, up 270%. There's GameStop, and then COS, which I think is a headphone company. So do you think that we're going to see more and more of these over the coming weeks?
Yes, I do, although I think that you're probably correct about the time period. These are the sort of mechanical things, mechanical anomalies that work for a short period of time. And right now it appears that the funds that with a high risk tolerance and huge assets under management, I'm talking about tens of billions of dollars under management, seem to be staying mostly out of the fray, certainly on the GameStop and also on some of these other heavily shorted and now rallying names. And so the individual investors who are communicating with each other over internet message boards, most notably the Reddit forum Wall Street Bets that has been where most of the GameStop action has been coming from. They are now emboldened by their huge success in GameStop, and they're searching out other places where small cap stocks have large short interest with the intent of buying the shares up and flushing out small and medium-sized hedge funds who simply can't take the pain of a big loser on a short position and who end up covering it and buying the shares back for the same people that bought them in the first place. So I expect that we're going to, as long as these people have accumulated profits from the GameStop trade, they're going to keep trying this in every little corner they can find with big short interest. How long it'll last? It lasts until the really big players decide they can't stay out of it anymore. There's too much money laying on the table for them not to try to take some. And then I think it's going to be over as quick as it started.
Okay. So, yeah. And, the beauty of our market system is how, democracy, can take over and blend with it. And so you've got, you got the little guy on Reddit, being able to have access to all kinds of information. And I'm sure there's some sort of Robin Hood leaders of the merry pranksters where somebody, they've got a trading account with good, good data, and they can, copy and paste a big list of the stocks with the highest short interest and post that on Reddit, and then they're all going to go after it. So it's created kind of a frenzy here. And, I like to see the little guy get rich versus Wall Street when he can. What's interesting is right before you and I came on this morning, Chamath, one of the leading leaders of the merry pranksters, was on CNBC, just talking about how much he loves this whole thing. And, he's a really smart guy. What's interesting is that he may have several of these special acquisition SPACs that are fueling this too. What can you tell us about the SPACs?
Well, the SPACs, for anyone that hasn't been paying attention, 2020 was the year of the SPAC, the Special Purpose Acquisition Company, in which a company went public with basically just raised cash, and the cash was sitting there waiting to make an acquisition. So they didn't have any business operations other than the intent to make an acquisition. They can then go and acquire a private company using the cash that they raised in their IPO, essentially bringing that private company public, but without any of the regulatory burden of doing their own IPO. Now, prior to 2020, SPACs charged roughly 20% across the board. So there was an immediate 20% dilution for the acquiring company to bring the private company public. That's become a lot more competitive. But it's still a concern that the private company is immediately diluted when they enter into the merger. The other thing is that the IPO process, although the regulatory burden, the bureaucracy can be kind of onerous, those steps are all there to protect investors, to make sure that investors have the most information possible about the companies that they are considering investing in. So the SEC is not out there trying to stifle companies from coming public. They're just trying to make sure that all the correct information is available for anyone that's making that investment decision. So a SPAC is sort of an end run around that. It's perfectly legal, but as an investor, I'm going to be a little bit more concerned. I'm going to pay a little bit more attention to a company that came public via a SPAC, because I know that I and other big investors, institutional investors who may be involved in the name, haven't had the opportunity to do the same due diligence as they would in a traditional IPO.
Yeah. So right now I'm showing a price chart of AMC Entertainment Holdings, which, vaulted, went from $5 to $20 and now settling in under 16. What's ironic about the whole SPAC thing is I knew nothing about them until I found out that, where did Virgin Galactic come from? And the stock symbol, I'm showing Virgin Galactic right here. The stock symbol is, oh my gosh, up to 58 today. The stock symbol for Virgin Galactic is SPCE, sort of, obviously a play on the word space. But this came from a SPAC that Chamath did with Richard Branson in 2019. And he actually, at the time, I think the symbol for his SPAC was SPAC, S-P-A-C. And that's what they used to, as you explained, it was sort of the end run IPO, right? To
Exactly.
bring Virgin Galactic public. Oh my gosh, look what they've done with this thing. And this is a 1 hour chart. So, I mean, this is just, so here we are just today, the 27th, we go from 42 up to 58. And this is also being driven in part by the fact that Kathy Wood and ARK Invest are going to launch a space ETF. So people were front running that. And now, so you've got this incredible momentum mania here.
Sure. The momentum can be your friend and your enemy. So in the case of GameStop, and back to your point about the sort of democratization of the markets and the idea of individuals acting as Robin Hood. Obviously the most popular trading service with millennials is called Robinhood for that very reason. The initial idea with GameStop was actually a reasonably sound idea. Here's a stock that's been beaten down for 4 straight years. So at the middle of last year, it was trading in the mid-single digits. Had started to kind of grind higher, had attracted the attention of a few big investors, including the founder of Chewy, who eventually took a seat on the board, which was part of the catalyst for the recent rally. And a lot of the investors on the online forums, especially Wall Street Bets, recognized that there was a lot of short interest in a company that was far from dead, and that they could take advantage of the mechanics of the market. And when I say take advantage, I don't mean in a bad way. I mean they could avail themselves of the mechanics of the market to get in on a stock with upside potential at a relatively low price and drive the shares high enough for the short sellers to have to buy them back or buy at least some of them back. So the initial idea and the rally of it seems like forever ago, but it was really only a couple weeks ago, really made all the sense in the world. And it was a case of individual investors banding together, sharing information, understanding the mechanics of the market, and making it work for them. As the stock went through $30, $50, $60, $80, it became completely detached from the fundamentals at that point. So it was no longer this information trade where individuals got the strength of a big group by sharing their information. It became simply a manic momentum trade. And I believe it remains that today. The higher it goes, the more convinced I am that this is based on a mechanical anomaly that's ephemeral. Cannot last forever.
It could also be the other factor that we didn't talk much about is that the size of the short positions could be greater than the existing float. Is that possible?
It is, and that's been reported that the short positions got up to 120 or 130% of the float, which is, of course, an issue. Now, frankly, I've been trying to research this over the past couple of days since they have been quoting that figure, and I'm having a hard time figuring it out because my understanding was that starting after the financial crisis in 2008 and 2009, we went to a system of assured locating of stocks before you could short them. So if I sell a stock today and my broker can't borrow the shares, there is a failure to deliver to the counterparty.
Right.
And if a stock has enough failures I still short the stock, and the person that sold it to me, or this person I sold it to is still long the stock. They still book the trade, but I haven't actually delivered the shares that I borrowed to the person that bought them from me, to the counterparty or to his firm. It was the case that if a stock failed to deliver in large enough numbers for a period of time, which I believe was 8 to 10 days, the stock would go on a list of stocks that meant you had to locate it before you could sell it. Your clearing firm or prime broker would not let you sell shares unless you had pre-located them, meaning you found them at another brokerage where they had long shares that were available to borrow and arranged for borrowing them, generally by paying a fee to borrow them, in some cases quite a steep fee, and that would allow you to sell short. Now, that system should prevent more than 100% of the shares from being shorted at any given time.
You would think, yeah.
Because you can only locate 100% of the shares. And in the case of GameStop, at least 20% of the shares are in the hands of 3 insiders. And so that makes those shares, if they're not going to sell, makes those shares impossible to find. So now we're down to like maybe 80% tops of shares that are actually available to borrow and sell.
And one of those
I'm
insiders.
not exactly sure where this 125% number is coming from. I think it's possible that happens intraday, because when you can't locate a stock, if you sell it, your clearing firm closes it out at the end of the day. If you close the trade first, you can be short it for a period inside a day, as long as it's closed by the close of trading. So it's possible that 125% number that we hear is an intraday number rather than an ongoing number. And it's simply people who continue to short day after day, as opposed to those who hold short positions overnight. Because the rules, as I understand them, should make it impossible for more than 100% of the shares to be held short overnight for more than, again, I can't remember the exact number, 8 to 10 days or so.
Yeah. Well, that makes sense. And I think what I learned from your article, I didn't know about the guy from Chewy that, got on the board. And obviously he's one of the big insiders. So we got to wrap it up. I want to make sure everybody finds Dave Boren's article here, how options trading is fueling the GameStop rally. One quick look at the Chewy chart, where he's one of the big insiders now in GameStop. And, everyone is taking on, the big hedge funds. In the end, I think Citadel, will have a scratch. Obviously, they bailed out that Melvin Capital, but Stevie Cohn has survived. Ken Griffin at Citadel will survive, and in the end, they may have the last laugh. And I just hope that the little guy isn't buying the top of these blow-off rallies. Thanks for joining me today, Dave, in the kitchen.
Thanks, Kevin.
All right, talk to you soon. Bye-bye.